Let's get a check on the markets right now. With markets off their highs of earlier today, you can see the Dow's up fractionally. Similar story for the S&P. The NASDAQ, similar story. The big thing that we're looking at right now is yields. Right now at 4.30. Just a short time ago, they were actually below on the 10-year, that yield, below 4.30. Also want to highlight the Russell, the best performer today, up just about 1% as we see those yields decline. And really, I think that's where we have to start this conversation. Joe, you're right here to my left. The movement in yields and some of the Fed speak that was the catalyst for that move, obviously earlier, given a bigger boost to the market, has kind of declined right now. What's your thought on what we're hearing? And again, we're going to have Steve Leisman join us in just a minute.
Yields are the story. 10-year was below 4.25. It highlights the value right now that's in the fixed income market. Clearly, over the last several days, equities are responding to what we're seeing in yields. However, I will point out this morning, the equity market reversal from where it was earlier is a little bit troublesome, just from the standpoint of if you're of the belief that at the end of the month we're going to see a significant surge higher. The appearance is the way we're trading today, markets seem to be a little bit overbought and a little bit tired from a significant November run. Last point on that would be the Russell. The Russell should have broken out more significantly than it did earlier this morning. It appears as though there's an apparent rejection for some overhead resistance. And again, we need to broaden out the rally beyond just the Magnificent Seven if, in fact, the weeks of December are going to be strong, similar to what we had in November.
Just to clarify, move higher. You're talking yields or equities?
Equities. Talking equities. Yields, I believe, the path continues to be lower for yields. I think the environment overall is suggestive of that.
All right, Kari, what's your take again? 10-year right now at 4.30. Earlier, as Joe mentioned, dipped down to about 4.25.
Yeah, well, this whole move with yields is, of course, what's driving the market. And as long as inflation keeps coming down, this is all tied to inflation, you would expect that the Fed is going to say at a certain point, okay, we should lower rates. And that's what the market is anticipating. There was a small percent of people who thought that rates might come down 6 months from now or 9 months from now. Now there are many more people who believe that to be true. And think about it, since October 27th, which was the recent low of the market has gone up S&P 11%, and many stocks have gone up 20%. Stocks like American Express, Blackstone, S&P Global, Adobe, those are names we own, all have surged. They're all related in some way to interest rates and being part of the growth universe.
You know, Kari, you said something right there. As long as inflation continues to go down, I think that was the key phrase you said right there. And speaking of the Fed and inflation, let's bring in our senior economics reporter, Steve Leisman. He spoke with Richmond Fed President Tom Barkin earlier today at CNBC CFO Summit. Steve, what are you hearing? What did you make of what you heard? More important.
Well, I think what he said, Frank, that's important. He spoke, by the way, exclusively at CNBC's CFO Council. He throwing some cold water on the optimistic outlook for Fed rate cuts next year that really captured the market's imagination yesterday. Barkin saying, hey, that could be the case, but he's not so sure about that. That talks about rate cuts are premature, and he would not take another rate cut off the table.
There's no particular need to do anything with interest rates if inflation's coming down. But if inflation's going to flare back up, I think you want to have the option of doing more on rates.
Barkin's concerned that companies are still in the mode of raising prices, and the outlook for inflation is not going to be a straight line. Could prove to be more stubborn than markets expect. Now, that was a bit of a contrast from yesterday when probabilities for Fed rate cuts in the spring surged after Fed Governor Waller said he was more confident the Fed was in the right place and acknowledged that if inflation does fall, the Fed could be cutting rates. Well, Barkin's comments had little impact on that optimistic outlook. Probabilities for rate cuts, 44% in March. That's even a bit higher today. So is the one for 78% chance of a cut in May and 93% chance by June, which means all but certain, as far as the market's concerned. But Barkin's comments show, hey, there are different camps in the Fed we need to pay attention to. There's those who are more certain inflation is going to come down and those who are a little bit more wary, guys, of declaring premature victory. Frank?